Friends, on behalf of Nagpur branch, welcome all delegates to this very important VCM on income tax and joint development agreement. Friends, we are real fortunate today to have honorable past presidents CAG Ramaswamy sir and Jaydeep Shah sir, both the past presidents today on our forum, along with learned speaker Chythanya K from Bengaluru, to speak on this very important topic of joint development agreements. Yesterday, Honorable Prime Minister Sir spoke about Charter for Taxpayers as well as about faceless assessments and appeals. I feel that is one thing which is really ripe in all our minds. But for today, real estate is the buzzword for today. Till the time you purchase your purchase property value increases in market, you are very, very happy for the notional gain. The real problem arrives when you sell it and have a huge gain. You are in tension now for the income tax due as well as for the exemptions to claim properly. The tension increases manifold when somebody suggests you for a joint development agreement and you agree to it. You are mesmerized and confused and perplexed now for the provisions related to it. And that's the reason Nagpur branch has come up with this unique idea of holding a VCM on income tax and joint development agreement for the benefit of all the members. To start with, I request the chairman of Nagpur branch, Kirit Kalyani, to give his welcome address on this occasion.
Thank you, Vice Saket. Yes, first and foremost, I guess I'm audible.
I request you all to please mute the mics.
Please wait a second, please wait. Yes, thank you, Saket ji. First and foremost, on behalf of Nagpur branch of WIRC ICAI, I welcome you all to this very crucial VCM on income tax, where we are going to deal with the taxation of joint development agreements. Yes, friends, I must say that we at Nagpur are trying every bit to plan VCMs for the benefit of members, and that too with topics of due relevance. So far as today's VCM is concerned, we are really fortunate to have number one, G. Ramaswamy sir from Coimbatore, Honorable Past President CM, is here. And yes, he is going to bless us with his wisdom as well. He is the chief guest for today's VCM. Friends, I must say, when I contacted him and requested him to please grace the occasion, and yes, we at Nagpur will really love to listen to you. He responded to the request very nicely, and yes, he is with us. He is not only gracing, but also yes, he will be blessing with his words of wisdom. I sincerely extend my good wishes and welcome you, G. Ramaswamy sir, on behalf of Nagpur branch of ICAI. Then, so far as CA Jaydeep Shah sir from Nagpur itself, Honorable Past President ICAI. Yes, he is a specially invited guest for today's VCM. We at Nagpur requested him because he always is available for the sake of members, for the sake of Nagpur branch. We requested him to please grace as well as bless with his words of wisdom on this occasion, as this is a very crucial VCM. CA Jaydeep Shah sir is here with us by taking time from his busy schedule. Sir, I sincerely extend my well wishes and welcome you as well for being here and blessing the occasion. And yes, friends, last but not the least, I must say, so far as CA Chythanya K sir from Bengaluru, I must say he is very renowned and so far as knowledge, his in-depth knowledge in the matter, in the subject matter is concerned. I must say I have received many recommendations, very strong recommendations for Chythanya sir, and the friends that are there at other branches, especially asked me to please request Chaitanya sir, and if yes, he comes, it is going to be very memorable for the members of Nagpur branch. And around 15 days back, I guess I contacted Chaitanya sir, and he really is kind enough to take time from his schedule, and yes, he's with us, and he's going to guide with respect to very crucial topic, that is income tax on joint development agreements. Chaitanya sir, I on behalf of Nagpur branch welcome you as well and extend my will for being here. Yes, friends, so far as Nagpur branch is concerned, yes, we are taking all efforts, all with the team Nagpur to plan VCMs with relevant topics. So far as forthcoming front is concerned, we have planned some VCMs. For example, the topics that are going to be dealt with are importance of robotics in auditing services. Then, so far as Companies Act matters are concerned, formation of private limited companies and basic compliances, we are going to deal with in one of the VCMs. Some more VCMs are being planned, but yes, the details will be shared soon to save time on this occasion. I will sincerely appeal you all to please stay in touch with the efforts in Nagpur branch and take maximum possible benefit from the deliberations and ventures of Nagpur branch. I sincerely once again extend my well wishes and welcome CA G. Ramaswamy sir, Honorable Past President ICAI and Chief Guest for today's VCM, CA Jaydeep Shah sir, Honorable Past President ICAI and specially invited guest for today's VCM, CA Chythanya K sir from Bengaluru, who is going to be the star speaker. And yes, we all are really going to be going to have value addition because of this deliberation, I must say. And yes, I with Chaitanya sir day for it, and he requested to resolve the queries, if any, during his deliberation itself. So the session will become an interactive one. And so far as the registration count for today's event is concerned, I must say it has crossed 300, which is the maximum prescribed strength for NVCM and Chaitanya sir and the facilities. It has become possible. I extend well wishes to all the attendees who are attending this VCM. And yes, before signing off, I sincerely wish you all a very joyous and fruitful session ahead. Thank you. It's over to you, Saketji.
Thank you so much, Chairman sir. On the eve of Independence Day, wherein we are going to celebrate our Independence Day tomorrow, on behalf of Nagpur branch, we wish all the respected members a very happy Independence Day and just a very happy learning for this session. Friends, we have got Honorable Past President of ICAI, Jaydeep Shah sir, for today. Jaydeep Shah sir doesn't need any introduction for any of us or all attending here. Honorable Past President sir, we welcome you sir here on this forum. And on behalf of Nagpur branch of WIRC, I now request you to please speak a few words on this occasion.
Right. Thank you, Saket. Chairman of the Nagpur branch, Sri Kirit Kalyani, Honorable Past President of the Institute, or rather my President of the Institute, because when I was Vice President, Ramaswamy sir was the President of the Institute. So I know him very, very closely. Ramaswamy sir, highly respected speaker for today's webinar, Mr. Chaitanya. I have heard a lot about him and it will be my privilege to listen to him. Vice Chairman of the branch, Saket Bagadia, Secretary of the branch, Jiten Saglani, respected seniors and my professional colleagues. In fact, Nagpur branch is organizing various webinars because of the COVID-19. Now it is almost impossible to organize seminars or conferences where physical attendance is possible. Personally, I feel that whenever any challenging situation is coming, certain good scenario is also emerging. And my personal view is that webinar gives an opportunity not only to the branch to organize a webinar on good topics, but it also gives an opportunity to the members attending the webinar to listen to experts from throughout the country as well as from the globe, because a few webinars Nagpur branch has organized where the speakers were from abroad, US, Dubai, and so many other places. So many times it is said that it is a boon in disguise. Nobody will appreciate the situation of Corona, but one good outcome which has come is organizing webinars where experts are available very easily. Of course, it is their sincerity that they are giving time and they are addressing the members. As far as today's President Ramaswamy sir, who is a chief guest, is concerned, I am having a very fond memory with him. In fact, it was a good coincidence that myself and Ramaswamy sir, we entered the council in the same year, that is 2004. We have relinquished the council in the same year, that is 2012 and 13. And I was his vice president. I know him very closely. He's a very humble, dedicated taskmaster also, but in a very humble way. Large number of excellent initiatives were taken during his presidency, whether it is for members or whether it is for students. And sometimes it does happen that when there is a gap of around 8 to 10 years, the concerned authority forgets what best thing he has done. Now, in case of Ramaswamy sir, I can share with you that apart from all excellent routine matters which has been handled, even very good initiative were taken at international level. Like course for valuation was started in Dubai, which was very successful. Then with the India Institute of Corporate Affairs, which is coming under Ministry of Corporate Affairs, MOU was signed, and which was very useful, where directors throughout the country they were a sort of given training, and institute was giving technical input. Then with Nepal Institute and Sri Lanka Institute, they were very keen to start ISA course, and during the tenure of Ramaswamy sir, that assessment test for ISA was entirely designed by our institute under the presidentship of Ramaswamy sir, and it was well appreciated throughout the world, because we are supporting other institutes like Nepal Institute as well as Sri Lanka Institute. On students front, lot of initiatives were taken, but one of the most important initiative was that all of us are aware that students are given 15 minutes reading time of the question paper before they can actually attempt it for 3 hours. So large number of initiatives were taken, and since I was his vice president, I know him very well. In fact, I feel that it was really my privilege to work under him, and he has really brought laurels to the institute. And we are today very lucky that he is a chief guest as well as a keynote speaker. And he is also expert on income tax, so his keynote comments or his queries will be very useful. We are also very happy that today Mr. Chythanya, he will be speaking income tax on joint development agreement, which is a very important topic. I will say that large number of controversies are still continuing related to joint agreement, and it is very important to understand that what are the criticalities related to the joint development agreement, capital gain, at what point it is arising, how the taxability is determined, whether it is a business income, whether it is a capital gain income. So many intricacies are arising, and there are so many judicial pronouncements also related to this. And we are very lucky that a very famous and expert Mr. Chythanya is the speaker, and all of us will be benefited by his deliberation. With this, I once again compliment Nagpur branch for organizing today's this webinar on joint development agreement, and convey my sincere thanks for calling me here. Thank you very much, and I once again compliment and welcome Ramaswamy sir as well as Mr. Chythanya along with other members who are attending the webinar. Thank you very much.
Thank you so much, Shah sir. You are always a guide and a philosopher for us for anything and everything. We're really fortunate to have you here, sir. On behalf of Nagpur branch, I now request the Secretary of Nagpur branch, Jiten Saglani, to kindly introduce our chief guest for today, Honorable Past President, CAG Ramaswamy sir.
Thank you so much, Vice Chairman sir. Friends, we have not just one, not just two, but three eminent persons, two in the form of past presidents and one in the form of speaker. And it is very rightly said that a single discussion with a wise man on a table is like reading many, many books. So friends, we have three people over here, and I think we'll be today gaining so much from these three illuminaries over here. Friends, I'm given a task of introducing Ramaswamy sir. It's my proud privilege. CAG Ramaswamy sir is a graduate from University of Madras. He's a commerce graduate. He's also a fellow member of the Institute of Chartered Accountants of India, a fellow member of the Institute of Company Secretary of India, also honorary member of Association of International Accountants UK, AIA, honorary member of the Institute of Chartered Accountants of Australia, honorary member of Certified Public Accountants of Australia, resolution professional member of IBBI and ICAI, advisory committee chairman of Indian Institute of Insolvency Professionals of ICAI. Friends, his profile, rather his name speaks volumes. But since I'm given a task and this is something that I would really love to, so I'm reading some sort of say excerpts from his elongated profile. Sir, please pardon me on this count. Ramaswamy sir, as I said, he's a FCS. Ramaswamy sir is the first president from ICAI who belongs to Coimbatore. So this is a unique part. Friends, he is into practice from past 35 years, and he is also a fellow member of ICSI. And as already stated, he is an honorary member of various other institutes which are abroad. Friends, sir is a member of National Advisory Committee on Accounting Standards, that is NACAS, and Government Accounting Standards Advisory Board for Union and States, constituted by CNAG. Being an insolvency professional with IBBI, he is currently the chairman of the advisory committee of Indian Institute of Insolvency Professionals of ICAI. Friends, he was elected to the council in 2004, and then he served as a president in his tenure at 2011 and 12 by the 21st Council of the Institute. Friends, he is also independent director of the Chennai Petroleum Corporation and nominated by the Ministry of Petroleum and Natural Gas, Government of India. He is also chairman of the audit committee and chairman of the CSR committee of Chennai Petro. Friends, he had also been a board member at IPAC for 3 years. He had been a board member at the Confederation of Asian Pacific Accountants, that is CAPA, and also he had served in various roles in the Central Council on the Disciplinary Committee, on various other committees such as Auditing and Assurance Standard Board, Ethical Standards Board, Development Committee, Research Committee, and the list goes on and on. Friends, he has served SIRC as a chairman in 1999. Sir, please allow me. It's just 1 minute more. Sir is a dynamic speaker, and he is expert on various subjects. He had been talking on various subjects across the places in India and abroad as well. So, friends, with this, I wish to conclude. But I wish to conclude on this note, which is of Mr. APJ Abdul Kalam, that he says that never complain about the difficulties in life, because a director, that is God, always gives the hardest role to its best actors. So we have two best actors in the form of Ramaswamy sir as well as Jaydeep sir. I welcome on behalf of the Nagpur branch to both the illuminaries as well as the speaker. Thank you so much.
Thank you very much.
Thank you so much, Jiten. It was a real pleasure to listen to the introduction of Honorable CAG Ramaswamy sir, Honorable Past President sir. I now request Ramaswamy sir to please guide the chartered accountants at Nagpur.
Very respected, my great friend and the past president of the Institute of Chartered Accountants of India, and the person who has worked with me shoulder to shoulder as a vice president during my tenure as a president, and has brought out many measures to move the council in the proper direction. With his help only, I was able to discharge my duty as a president of the ICAI. Mr. Jaydeep Shah is very elaborately has discussed about many matters, which are all on the help of all the council colleagues as well as the vice president. They have put a lot of efforts for bringing the best efforts out of the entire council. And we all know that Mr. Jaydeep Shah is As far as mine is concerned, is a very simple personality. From Nagpur, I have a very lovable and affection towards Mr. Jaydeep always. From the day one we entered in the council in 2014, we have about called the G8 we entered. We called about 8 newly elected council members. We formed ourselves as a G8 with a lot of inspirations from the former presidents, and we want to do something good things for our institute. We joined together. Out of G8, 4 people have completed their presidentship, and we came out. 4 as opted out from the presidentship as well as not continued in the council. The council activities are very important for the growth of the profession. In fact, everyone should contribute as a council member. President is only a person, is one among the council members, driving the institute in the front of as a driver. So to that extent, Mr. Jaydeep has given me a lot of support. Very simple personality, and we've gelled well, and we have done a lot of good work with the help of the council members and the members. And it's my proud privilege to sharing this webinar with my good friend and Vice President and President of the ICAI, Mr. Jaydeep Shah. Very respected Chairman, Mr. Kirit Kalyani, the Chairman of the Nagpur branch. Nagpur branch I visited many times. Very wonderful branch, and you are leading a very important branch in this country. He has given a lot of inputs to the nation. Nagpur means we have always considered as a very patriotic center, and it's a center which is providing many support to the economic development of the nation, policy making, decision place, and we all thought that will be a great opportunity to interact with all of you. You have a place where there is resources are available, and a technical as well as an exemplary persons have come from Nagpur. And the vice chairman, the future chairman of the Nagpur branch, Secretary Bakadia, the vice chairman, the CA Jiten Saglani, the secretary of the Nagpur branch, and my good friend, very respected advocate, chartered accountant, and a very great humanitarian from Bengaluru, Karnataka, a person with a lot of wisdom, knowledge, is always happy to share his knowledge very politely and humbly and very authentically. He will share his knowledge. And Mr. Chythanya, and very respected fellow members, seniors who are all participating in this webinar. My good evening to all of you and my best wishes to all of you. We are celebrating the 74th Independence Day tomorrow morning of 15th August 1947. It was come to us 15th August 2020. We are going to celebrate our 74th Independence Day. Independence, integrity, excellence are the hallmark for the chartered accountants. We, the chartered accountants, be proud of the partners for the nation building. We are always a part of the nation economic development. That is why the Honorable Prime Minister has invited our ICAI President yesterday for launching of this tax charter. The CBDT has invited our ICAI President, along with the Prime Minister of India, is launched the charter for the taxpayers. In fact, the number of initiatives started for the last about 10 years, maybe in 6 years, I can say that the reform started, faceless assessment, e-assessment, and as well as the now e-appeals, compliances under the various laws, and especially on 1st July 2017, the Honorable Prime Minister launched the GST, the One Nation, One Tax, and the platform of the ICAI on the Chartered Accountants Day on 1st July 2017. It's a proud moment for all the chartered accountants. Today, in every nook and corner, you can see that economy is limping towards the development, and there are a lot of measures taken by the government providing the support in the form of a financial as well as the psychological support to the people by way of providing support to the MSME, bringing out a lot of measures of financial supports, changes in the form of restructuring of the loan, and as well as many things are happening in this country. We have seen the last 4 or 5 years, in fact, since the GST, before GST demonetization, and complying with the various other laws, the amendment under the Act 115 BBE with reference to the levy of penalty, changes in the method of removal of 217 1C, and the new law of misreporting, underreporting. So many factors are coming up for filing of returns, and all the assessments are taking place, faceless assessment, and there will be a number of cases which are all pending before the various court and tribunals. ICAI is now the method of Vivad Se Vishwas is available for it, and similarly there are a number of measures they have taken in the other laws also. We, the chartered accountants, small and medium practitioners, mainly focusing on the taxation, it's a great breadwinner for the chartered accountants. In fact, many people have mentioned that in future, the income tax law will be completely abolished. There will be a new law will come, and it will play the economic development in the form of a collection of tax and other revenues for the government. But it's not like that. It is always there since 1922. The chartered accountants are visioning maybe an accountant at that time. The Income Tax Act, later on 1961 Income Tax Act, and it was been amended so many times, which Mr. Chythanya is watching with he knows the number of times the amendments is taken place in the 1961 Act itself. So people have started tax planning, and the tax planning in the form of maybe in the form of a tax avoidance, and the decision rendered by Diabase like that 154 ITR in the McDowell's case, where the Supreme Court very clearly mentioned about it. You are paying the tax for the purchasing of your civil liberty. So there will be tax planning, which are all in the form of a dubious colorable devices, which are all to be considered to be as a criminal activities. That is why it has taken a number of measures of avoiding the tax planning, plugging the loopholes of many things. Similarly, there are a number of the issues are coming up before the taxpayers' grievances. One of the issues which Mr. Chythanya is going to address to all of us about the joint development agreement, wherein when you entered into an agreement under the joint development agreement itself, Section 247 is very clear with reference to Section 53 of the Transfer of Property Act, as well as the Transfer of Property Act 1882. That's very clear that in case of any arrangements or an agreement entered into with any agreement and handing over the possession for the furtherance of an agreement in amount to a transfer, even though there is no monetary benefit to the landowner or a person who is transferring the property, but they have a liability has been fastened upon them based on the agreement. There are a number of disputes started, and number of discussions are taking place in the tribunal level, high court level, maybe on the Supreme Court level itself. So tax planning started. How to say that some of them have mentioned that I am only giving a license, I am not giving the possession. Possession has been given, but the activities has not started. But the department has taken a view. All these things cases, it is a liable under the income tax for the capital gain without any furtherance of whether you get the money or not. It's a great disadvantage, grievance of the taxpayers, really, that without receiving any money, I will not be able to do anything. I'm not able to invest in Section 54, 54F, all these things. And these are the things which are all as number of days it has come out. And there are a number of via medias. People have started working in case if you have a very small plots and they are working, how the family members can divide. In case of an HUF property is there are about 4 or 5 people are the co-partners. Maybe ladies are co-partners, my son and daughters are co-partners. The Indo Succession Act has put some impediment for them, the claiming of partition for the ladies also. But the growing disputes among the family members and some of the issues which are all the lands are not available within the city, and the requirements of the immediate funds for the developers, the concept of joint development has started, wherein the builder or a developer need not invest the entire amount of his cash flow, will not be affected, but he can enter into an agreement with the landowner, wherein the landowner can be benefited out of this entire transaction. Instead of selling the land in a single manner, a small amount of transaction sale amount he will be getting as a consideration. But in future, if you allow it in the joint development agreement, he will be able to get a huge amount of place wherein he can keep the location there itself where he is residing presently, and he can divide among the family members. Each one have a one piece of house for them. So like that it has started, and that will be an exemption claim started relating to the number of flats, whether I am entitled for a 54A or 54F, whether the number of flats, one flat I am exemption, or a 2 flat or a 5 flat, or it be entire flats have been, can claim exemptions. The genuine exemptions are given originally for you are entitled for one flat, but later on that the law evolved in such a manner, the interpretation started, wherein you can claim the entire flats as a single unit, you will be given an exemption. So matter has been accepted by the various high courts and the tribunals, stating that number of interpretation arising out of that, and the people have started getting a whole benefit without paying any capital gain tax. So everywhere the tax planning started in such a manner. For example, in the case of any small plot is there where the family members are there, then they will be using the division among themselves. It may be an HUF property. The requirement under the law, in case of a partial partition, is not allowed under the Income Tax Act for the purpose of the levying of tax. If there is a partial partition, it is not recognized. If it is a full partition, meets and bounds, if it is a property is dividable, then partition can be recognized under section 171 of the Income Tax Act by the income tax officers. And in case of a small plat, how to bring its construction, maybe the meets and bounds. See, other words, there is also a provision available in case you are not able to divide them into meets and bounds, then you can divide them according to your other modes of divisions. Division started, the properties, whether the family arrangements can be considered as a valid document without registration. And even many registration act has been amended in such a manner, if any document which is not registered cannot be enforceable under the law, including the family partition, including the joint development agreement. People have started questioning that I have entered into a development agreement, it is not registered with any of the income tax registration authorities. Naturally, the law, this agreement cannot be enforced under the law. You cannot levy the tax on me. So the number of interpretations started in joint development agreements. One is relating to my joint development agreement is not registered. I am not subject to tax in the year of entering into an agreement. So interpreted in such a manner, the section 247 said it is not necessarily you register it in the like manner, in the similar manner. If it is there, it is enough. Section 53A is never says that should be registered. So Registration Act reserved section 53 of the Transfer of Property Act. They consider it. Many interpretation comes that department is taken a view. It has to be in a like manner. It is not declared to be registered. You have to pay the tax. So family arrangements, people have started. Yes, I have a small plot of land, about 20 cents of the land. I'm going to construct about 30 flats or 20 flats, 10 for my family, 10 for the builder. Out of 10, my family members, 4 people will take 111. I won't get an exemption on that. Whether each one is entitled or not, combined with it's an HUF property. Without proper partition, you cannot go ahead. So there is the Supreme Court decisions. Even very recently, the Supreme Court has come out with the decision stating that family arrangements, the number of cases, family arrangements need not be a registered document. Memorandum of understanding among the family members is not required to be registered. Based on that, you work out a tax planning and you can divide the family property in such a manner. All of them enter into a joint development agreement. Individually, you can get a share, and individually you can apply the share for an exemption under section 54 or 54F, get an exemption. So that is the point which is all interpretation started about the documentation point of view. One is on taxation point of view, another is a documentation point of view. The interpretation started on that, the disputes have started. In fact, the family arrangements predetermined. We already that there was an arrangement among the family members. Subsequently, a written document is created by them without registration. So that can be considered as a valid agreement. That is the way they have taken valid document to be executed. And section 171 is always playing a role. Somebody has said section 171, I am not an assessee, I am not filed the so far returns. But how I can go and approach the income tax officer for the full partition, recognition of my partition under section 171. The matter relating to earlier, there was a Tamil Nadu government has given an approval. I mean, in 1989, the Tamil Nadu government has amended the act in the Intersection Act in a part in Tamil Nadu. All the lady members' daughters are also considered as an equal. So there was a tax planning is considered by one of the person. He has divided the property among the documents by way of family arrangements within the daughters. But the matter has been questioned by the income tax officer, state that the 1989 Act is giving a permission only where there is a co-partner and there is a partition takes place, then only the ladies are going to claim the right in this property. Here there is no partition has taken place. It's only you are planned in such a manner, a sham transaction, sham agreement you entered with the family members, because the family consisting of only one male member, all others are female members. So they are not entitled for that. Very recently, the Supreme Court has come out with, based on the 2005 Hindu Succession Act, wherein that daughters are equal right has been recognized, even though at the date of September 9th, 2005, the father is died, is no more at that time. Once it is there, then once the daughter is always daughter, she is entitled to claim the share in the property. So like that, there will be a number of practical measures, number of issues are arising out of that when you're going for a joint development agreement among the members, full partition, partial partition, share to a lady member, share to an unmarried daughter, so many maybe a wife of a person, so many other things are coming up. So it's the right time you have taken, and there is an amendment later on, it has come relating to relief to the taxpayers. Number one, section 45(5)(a), I think is going to deal in it entirely with the aspects related to this, wherein if there is a person is a HUF for an individual, this particular amendment is applicable to the HUF for an individual, not for companies. Wherein in that case, if there is a issue relating to the entering into a joint development agreement, special agreements they have mentioned, if it is later on and if there is a development agreement and there is a completion certificate date is the point for taking up the capital gain tax, which will come in case there are certain provisions are there, interpretations, you will be able to do that. There is an interpretation that law as 45(5)(a) is given the benefit of shifting the tax, not shifting the transfer. So for computing the transfer, go to the date of an interim agreement. For a tax, you go to the date of a completion certificate or otherwise. That's an interpretations are coming up. So you will lose the exemption there, and you may that. I think Mr. Chythanya will throw light upon that interpretations. Is the right person to give the interpretations from the legal point of view. We have very fortunate to have Mr. Chythanya, and wonderful event. I'm also eagerly waiting to hear the interpretations, discussions, and debates from the Chythanya's point of view, and also from other learned members are also going to participate. Whatever the questions they are going to raise, that he's going to answer. It will be a feast of knowledge for all of us. And I thank the organizers, especially the chairman, Mr. Kirit Kalyani, who has given me this opportunity, and my great friend, Mr. Jaydeep Shah, invited me to join this webinar. Thank you, one and all. Thank you very much. And we will celebrate our Independence Day, 74th Independence Day tomorrow morning. Jai Hind.
Thank you so much, Honorable Past Chairman, sir. This has been a real pleasure because the things you have said, you have just formed the base for the learnings which we are going to make in the next 1.5 hours to come. So we're extremely thankful to you, sir, for your precious talk on this very important topic. On behalf of Nagpur branch, now I request to see Akshay Gulhane, because our chairman, to please come ahead and introduce our speaker for today, C. Chythanya sir.
Thank you so much. Thank you so much, Saket sir. Am I audible?
Yes.
Good evening, friends. It is my immense pleasure to introduce the scholar, I would say, Chythanya K sir. Sir is BCom, fellow chartered accountant and LLB. He stood first in BCom exam in Mysore University. In CA intermediate, sir scored 47th rank All India. In CA final, he scored 15th rank All India, topping Karnataka state. In professional front, sir did his articleship from PwC Bangalore. He completed his industrial training from Hindustan Lever Limited, Bangalore. Sir is practicing as chartered accountant for 14 years, specializing in taxation matters. Now practicing as an advocate in Karnataka High Court. Sir has lectured at IIM Bangalore, MDP of ICAI New Delhi, MDP of ICAI Bangalore, and Direct Taxes Training Center of Income Tax Department. Sir has also presented various papers in income tax and VAT at various metros and other cities at forums of ICAI, BCAS, CTC, Mumbai, IFA, Society of Auditors, AIFTP, BCIC, etc. He is also a member of study group of ICAI for framing guidance note on transfer pricing. Sir has authored 2 books, Tax Holiday under Section 10A and 10B, and Decoding Section 5, published by Oak Bridge, and also authored a book on Special Economic Zone. Sir has contributed in articles of Chartered Accountant, BCAJ, Taxman, etc. He has deposed before Committee on Direct Tax Matters, headed by Honorable Justice A.P. Shah, on the levy of MAT on FIS. Country reporter for India for IFA Seoul Council Congress 2018 on withholding tax. We welcome you, Chaitanya sir, and very much eager to listen to you. Thank you so much. Over to you, Saket sir.
Thank you so much, Akshay. It's a pleasure for all of us to have C. Chythanya sir from Bengaluru to speak on this very important topic. Without wasting any more time, I request Chythanya sir to please start his presentation on this very important topic. Chythanya sir, kindly unmute your mic. Chythanya sir.
Can you hear me?
Yes, sir.
Am I audible?
Yes, sir. Yes, sir.
Yes, I would thank the chairman of Nagpur branch and other office bearers of Nagpur branch for having invited me for a lecture on the joint development agreements and the tax implications. And my pleasure to have Mr. Ramaswamy and Mr. Jaydeep Shah to my left and to my right. And I recollect my fond memories in the ICAI Bhavan at Indraprastha Road during Mr. Ramaswamy's tenure there, where we were involved in revising the guidance note for the transfer pricing. And it's my pleasure to have him around this occasion as well. We would straight away get on to the topic, and I guess my screen is shared. Are you able to see the screen? Are you able to see the screen?
Yes, sir. Yes, sir.
Okay, now, essentially, when you would look at the tax implications on the joint development agreements, you would have to deal with it qua the landowner and qua the developer. So the different issues would arise so far as landowner is concerned, and the different issues would arise so far as developer is concerned. And when you would plan, many a times there would be a conflict between the advisors which the consultant of a landowner gives versus the advisors which the consultant of the developer would give. While the consultant of the landowner would be keen to ensure that his client would not pay tax instantly, the consultant of the developer would be keen to ensure that the developer's interest is safeguarded so that the landowner wouldn't backtrack. So as chartered accountants and advocates, when we advise our respective clients, it requires a very, very fine balancing act whereby your advice to your client should also be practical enough for the consultancy of the other party. It could be developer in one example, to also accept your thought process. Otherwise, like in the course of we over eagerly advising our respective clients, the deal itself should not fall through. So end of the day, the landowner and the developer will have to do the business together. That is why we get our fee. So we'll have to ensure that the business goes on, and as we try to protect the interests of the clients. Now let's look at the case of landowner first, and I guess we may not have time to deal with the case of developer, considering that it's already 5:45. But I'll not rush through. We will spend the time leisurely, and please feel free to ask all the questions, whatever that would arise to you, as and when I take pause for the questions. So starting with the landowner, what are the issues that would arise? Firstly, whether the capital gains or the business income. The characterization of income is the first ever issue that would arise. Secondly, as Mr. Ramaswamy most aptly put, the timing of tax. You would have a situation of having to pay the tax when there is no inflow of consideration. Thirdly, how do you determine the consideration? Even if you have to pay the tax at the time you sign the JDA, your consideration, particularly in the form of built-up area, that would come to you after the developer builds, obtains the occupancy certificate, then deliver you the built-up area. That could take 3, 4, 5, 6, 7 years. And we would really not know how to determine the value thereof. In which case, if you're asked to pay tax upfront, how do you determine the consideration? Next issue would be, yes, the developer would give you the landowner's share. You would have the flats coming to you. You would then eventually sell away the flats. So how do you compute the tax in respect of the gains that you would make upon sale of such flats? What are the incentives that are available? Mr. Ramaswamy already mentioned sections like 54, etc. And you will have then the issue of TDRs, transferable development rights. How are we going to deal with these TDRs from the point of view of income tax? Then we'll have withholding taxes in terms of 194 IA and 194 IC. Then, as Mr. Ramaswamy mentioned, you have section 45 5A, which is brought in, which would deal with the case of an individual and HUF, whereby it's possible for him to defer the point of taxation to the year in which the appropriate authority would give the completion certificate to the real estate project. Now, these are the issues that we are going to discuss, and we will now take up these issues one by one. Starting with the characterization, the question that would arise is as to whether the land, from the landowner's perspective, is it held as capital asset or is it held as stock in trade? And obviously, if it is held as a capital asset, then you're all experts. You would know how to determine the long-term capital gain, short-term capital gain, and indexation. I'm not going to spend time on those aspects, of which you are already experts. Then, of course, if the land is held as stock in trade, then the income will have to be computed as part of profits and gains of business or profession. So these are just a summation of provisions that would apply. When you would compute it as capital gains, if it is long term, again, you will have the aspects of indexation. You will have the rate of tax, which is the concessional rate of tax under 112. But then when it comes to determination of the full value consideration, you would have 50C/50D, which could apply. You would get all the rollover benefits in terms of 54, etc. If, on the other hand, it's a short-term capital asset, whereby you would have held the land, building, or both for a period not more than 24 months, then in which case you will have to pay normal tax on your incremental profits, which you would make. No incentives are available. On the other hand, if it is charged as business income, you will have the normal rate of tax that would apply to you, and you wouldn't get the benefit of rollover, etc. The concessional tax under 112 is not applicable. And the consideration, of course, you will have a provision similar to 50C, that is 43CA, where whatever consideration that you would receive or that would accrue to you will have to be benchmarked with the stamp duty valuation, and obviously whichever is higher will have to be adopted. The silver lining when it comes to business computation is you wouldn't have a situation of 247 of the Income Tax Act being applicable to you, which would advance the point of taxation to a period prior to your receipt of consideration. 247 various manifestations of 247 which would deal with the transfer would apply only when it is a capital gain, and not when your land is held as a stock in trade. Now, the moot question is, on what basis would you decide whether your land is held as capital asset or stock in trade? So this is a highly vexed question, and you cannot have a standard set of rules that would determine as to whether your land is held as capital asset or stock in trade. In fact, you could possibly take a leaf from the circulars and instructions issued by the board, starting with instruction number 1827 of 1989 and going up to circular number 4 of 2007, where the board gave a list of different case laws. Though they are called instruction and circular, essentially did not give any principle as such. It just gave out, the gist of various cases, and has said that all the factors will have to be considered. And more later circular is circular number 6 of 2016, which in fact, of course, these circulars you'll have to appreciate that have been issued in the context of shares and securities, but I'm sure the principles which are emerging from these circulars could as well be applied to any other capital asset, which would inter alia include land. So circular 6 is an interesting one, which says that normally what the assessee shows should not be disturbed. If the assessee were to call it as inventory, it has to be accepted. If the assessee were to call it as the stock in trade, it has to be accepted, provided the only caveat is assessee has to be consistent in his approach. So consistency is the hallmark here. You can't be calling in 1 year as an inventory and 1 year as a capital asset and keep switching over depending on the tax benefits that would inure to you. So consistency is extremely important here. And as I've said, these circulars and instructions, though have been issued in the context of shares, would as well apply in the context of land, because the principles cannot be different. Another important aspect of circular 6 of 2016 is it recognizes that you could have two portfolios, one of inventory, one of stock in trade. For example, let us say you are a real estate dealer. You will have lands and flats held as inventory. You could also hold a few of them as your capital asset. There is no rule that if you are a dealer, or whatever asset you have held is to be regarded as stock in trade. You could have twin portfolios. Now coming to the decisions here, the earliest decision that is available here and a very landmark decision is Venkataswamy Naidu's case 35 ITR 594 of Supreme Court. And it went on, and you have had several decisions, but then the way of doing business has evolved over a period of time since the decision was first rendered in Venkataswamy Naidu's case in 1959. So therefore, I would recommend you to look at the decision of Gujarat High Court in Reva Shankar Kothari's case, 283 ATR 338, where Gujarat High Court has given you a checklist of about 12-13 factors. Of course, with a caveat that no one factor will have to be solely considered. You will have to, have a collective consideration of all these parameters and then take a conscious call. So in Karnataka High Court in Bagmane Developers Private Limited, where I had the occasion to argue this case, it's a very interesting situation of assessee called it as stock in trade. But there was a search in the assessee's premises. Then 153A notices were issued. In the returns filed in pursuance to 153A, assessee called it as a capital asset. As the department assessed Bagmane Developers, the department took a view that, look, in the returns which you had normally filed earlier, prior to search, you had already called it as stock in trade. How is it that you could, call it as capital asset in the returns filed in pursuance to 153A? So department continued to hold it as the stock in trade. The matter went to CIT appeal, who affirmed the view of the assessing officer as is the normal case. Then when the matter went to tribunal looked at various aspects, including the time when the assets were bought and shown in the books of account of Bagmane Developers, and eventually held that the assessee was justified in calling it as the capital asset. The matter went to High Court. Department filed an appeal to the High Court. In the High Court, the High Court considered the principles of Reva Shankar Kothari's case and then looked at each of these factors, and on an overall basis, the High Court agreed with the position which the assessee took, that the land in substance is held as a capital asset, although by mistake it was shown as stock in trade in the original returns which it had filed. And the High Court accepted the case of the assessee. So why I've explained this situation is, at times you could possibly make an error of reflecting a particular asset as a capital asset or stock in trade in a return of income, but you're not stuck to it. There is no estoppel here. If you're able to bring out the proper evidences which would establish that it was a bona fide error on your part to have wrongly classified it in a return of income, then you're always permitted to bring it to the right position. So as long as your facts are sufficient enough established, there should not be any difficulty in you being able to convince the officers. Now, there is another common question that would arise in the context of a landowner is that, see, normally these landowners don't have this, like a habit of entering into JDA very often. You would have had some inherited property or a property that you would have bought long before, which now you would not want to build a house. You would possibly want to rather stay in an apartment than in an independent house. Normally these are not too frequent transactions. They're one-off transactions. Now, the interesting question that would arise is, can the department regard even one-off transaction of the landowner of giving his land to the joint development as business? So the larger question is, can a single transaction be regarded as tantamounting to business? So if you look at the definition of section 2 within brackets 13 of the Income Tax Act, it says, what is business? Trade, commerce, or manufacture, or any adventure or concern in the nature of trade, commerce, manufacture. The word adventure is not something which is done on a regular basis. So therefore, there are some decisions which have taken a view that even if it were a single transaction, if it has all the characteristic features and the trappings of a business, it could still be called as business. You have the decision of Madras High Court in SP Balasubramaniam's case, the famous singer in 250 ITR 127, and you have the Supreme Court in Sutlej Cotton Mills case 100 ITR 706. But then there are other decisions as well. You have one of the recent decisions of Kerala High Court in John Poomkudi's case. You have one of Bombay High Court in Indian Hume Pipe Company's case, and you have one of Allahabad High Court in Shashikumar Agarwal's case, where, considering the background of the assessee, the courts took a position that merely because you have given it out, and as long as it is established that it is not your, you're not habitually, doing this kind of an activity, then applying an old ratio emanating from the decision of Supreme Court in Raja Bahadur Kamakhya Narayan Singh in 77 ITR 253, the courts also have held that a single transaction would not amount to carrying on business. My view is that a single transaction per se cannot be regarded as business unless there are some very strong evidences to establish. Normally, a single transaction would not constitute carrying on of business. So as we move to the next topic, I would just take a very small pause here and invite questions, and I would request the delegates to raise questions only in respect of topic which have so far dealt. If there are no questions, I will proceed. If there are any questions right now, you could ask me. We'll take a very short pause. Yes, sir. Are there any questions, Chairman, sir? Mr. Kalyani, are there any questions? Can you hear me? I can't hear you, but.
Chat box, nothing.
Oh, nothing. Okay, we'll proceed now. Yeah, there is no question then. Okay, we'll. You can always come back to me on questions later on. Now we'll go to the most important topic of timing. So there are two clauses in section 2 within brackets 47, which could be of anxiety to the taxpayers from the point of view of landowners. One is 247.5, the other one is 247.6. Many of us tend to think more on 247.5 and tend to ignore 247.6. So I would want to state that both are equally important, and it is not enough for you to just exhaust one clause. When you advise the clients, please keep in mind both the clauses, and you'll have to rule out the applicability of both the clauses. Now we will look at 247.5 first. What is 247.5? 247.5 will deem any transaction which will involve allowing of possession of any immovable property to be taken or retained in part performance of a contract of the nature referred to in section 53A of the Transfer of Property Act. Now, what does it actually say? It says, if you have got into any transaction of the nature referred to in section 53 of the Transfer of Property Act, then that transaction would be regarded as a transfer. But then it has to have some important ingredients. This transaction should involve that the possession is moving from landowner to the developer, number one. Number two, this contract will have to be in writing. Number three, this contract is required to be registered. Number four, the other party, developer, has carried out some part performance of the contract. In consideration thereof, the landlord is giving away the possession. Then, lastly, the terms of the agreement, the terms of the contract are easily discernible. Then, 53A of the Act would pitch in. It would say that despite the fact that the sale deed is not registered, the seller or any person claiming through him cannot enforce the rights of the buyer. So qua the seller, not qua the world at large, qua the seller, the buyer is safe. So buyer is deemed to be owner. Only qua the seller. Seller or people acting through him cannot, like take back the ownership from the buyer. So this is the effect of 247.5. This has been brought into Income Tax Act by Finance Act of 1987 with effect from 1487, and Circular number 495 explains the purpose why it is done, and the mischief here which is sought to be remedied is people through this kind of an agreement would essentially take bulk of the consideration, give away control over the property, but do not register the sale deed, whereby they will deliberately defer payment of tax. Now, what are the issues that would arise from the point of view of landowner? See, the moment 247.5 is pressed into service, it is regarded as a transfer, and there's going to be an immediate outflow of your cash by way of tax without the corresponding inflow of gains. And you would not know when your consideration would ever come, because the developer will take your land, then proceed with the development, and eventually obtain the completion certificate. If his project gets stuck on some damn litigation, then your consideration would never come through, by which time you would have already been poorer because you had already paid the taxes. Then Mr. Ramaswamy was mentioning about the 5454F benefit. See, earlier, at least up to the amendment made by Finance Act of 2014, where most courts interpreted a house as any or many houses in terms of section 54 and 54F. Now, people were able to mitigate the hardship of 247.5 by saying that, I would want all these flats for myself. For example, if I have the land and Mr. Ramaswamy is the developer, and I have given the land to him, and he would give me, say, about 30 flats. He builds about 100 flats, and he gives me about 30 flats. Up till Finance Act of 2014, I could have claimed 54 and 54F in respect of all the 30 flats. because that is how it was interpreted. So it was possible for me not to have paid the tax. By claiming the benefit of 54 and 54F, I would have neutralized the effect of 247(5). But after this Finance Act of 2014 amendment, they have restricted it to just one house. Of course, now in the context of 54, you have two houses in a very, very, limited situation of a capital gain not exceeding 2 crores, and it's once in lifetime opportunity. Otherwise, it is normally one house. So therefore, after Finance Act of 2014, the hardship has only increased because you could not have neutralized the effect of 247(5) by taking the benefit of 54 for multiple flats. Then another hardship that would be associated with this kind of a provision is you would enter into JDA, give away the land, pay the tax, and eventually the JDA may be cancelled. It may be cancelled after 3 years, 4 years. Even your remedy by way of 264 would have been lost. So it becomes extremely difficult because there is no provision in Income Tax Act to redress the situation of one having already paid the tax under 247(5), but later on, the transfer wouldn't actually be fructified, the JDA may be cancelled. What kind of recourse does the taxpayer have? The income tax does not act, not this. Then take the case of the company. A company will end up paying tax twice over because of 247(5). Take an example where a company is the landlord, it will give away land in JDA. In the year in it gives away land, it has to pay tax under 247(5), though it would not have received any consideration. So it would not even have booked any income in its books of account, but it pays tax in year 1. Let us say in year 4, it will get the consideration, it will pass an entry in its books of account. In that year, it will be part of its book profits, whereby it will end up paying tax on MAT. So therefore, a company could possibly be unwittingly caught twice. Firstly, in terms of 247(5), secondly, in terms of book profit tax and 115 JB, and there is no mechanism in Income Tax Act to give you relief in respect of the taxes which are previously paid as we compute the book profit later on. Now, there is one decision of Supreme Court in Sanjeev Lal's case, which also is, is causing problem. This case, as such, was an interesting case which gave benefit to the assessee. This is 365 ITR 389, where the assessee had entered into an agreement to sell a particular property and got some money, which money he invested. But he could not have sold the original asset immediately for some litigation. After 4 years, he sold the original asset. So transfer of original asset took place after 4 years. But the new asset, he had acquired it in year 1 itself. As soon as he entered into agreement, he got some advance and bought on flat. So department denied the benefit, saying that you ought to have bought the flat within 1 year from the date of transfer, or within 3 years after the date of transfer, but you acquired it more than 1 year before the date of transfer, then we'll not give you the benefit. So matter reached the Supreme Court, and Supreme Court said that, look, in year 1, when he had entered into agreement to sell, that itself will have to be treated as the date of transfer. And accordingly, the Supreme Court said that he is eligible to claim the benefit of Section 54. Though this decision is beneficial in that context, imagine department wanting to use this decision to say that every damn agreement you have entered into, your agreement to sell, is to be regarded as a transfer, and hence Section 247 is attracted and you are liable to pay tax under Section 45 would be quite far-reaching way of looking at it. Though it will look quite far-fetched, department is not unknown to be making these kind of moves with an intention to garner as much tax as possible, rightly or wrongly. Now, so I have taken you through the difficulties that a landowner would face because of 247(5). What is the way out of this? There are different ways of overcoming it. If you do not want your client to suffer instant tax because of 247(5), there are different methods which you could use. So I have just listed here, and I'll take you through each one of it as I run through the list. First is by not registering JDA. Second is applying the language of Section 45, which uses the word the profits and gains arising. Thirdly, you could think of conversion of a capital asset into stock in trade. Fourthly, you would, if the transaction took place prior to previous year 11-12, you could argue that the consideration is indeterminate. And 50D has come in only, from the previous year 12-13 onwards. And even when 50D comes, you could actually make use of 247.5 to, significantly save the tax in a revenue sharing arrangement. I'll explain this a little later. I'll only, very broadly deal with them now. And the next one is what Mr. Ramaswamy is trying to hint. 54 benefit is applicable only in respect of one flat. What if we could, consider the case of partition of a Hindu undivided family whereby the land is split between multiple co-parsonage of the family, and thereafter you enter into JDA, whereby rather than it is the case of HUF being the assessee, it's a case of multiple members individually becoming assessees and the transferors, and each one of them would then get the benefit of section 54. So you could consider this, if it is a Hindu undivided family, you could consider this by way of looking at a complete partition of a HUF. If it is not a Hindu undivided family, but it is a family property. So there's a difference between a property being a family property being a Hindu undivided family property. Hindu undivided family property is on the basis of the Hindu school which you would follow, where HUF itself is the person who pays the tax. Family property need not be HUF property. For example, me and Ramaswamy, Mr. Ramaswamy are brothers. We've been simply, we are earning our separate incomes. He is earning his income as a chartered accountant. I am earning my income as an advocate. We are just putting in money together and simply keep on buying properties. Some in his name, some in my name, some jointly. My monies are invested in his houses. His monies are invested in my properties. But one fine day we decide, okay, tomorrow, and it's not HUF property. We consider this as each property, we consider we have some rights. So one fine day we will decide we will not go for this anymore, because tomorrow, right now, so far we are fine. Tomorrow we'll have children, grandchildren, they may not have the same, equation as we two have. We would want to go for a family settlement. A family settlement should not be mistaken for total partition of a Hindu undivided family. In a family settlement, we could do a proper settlement between us and then divide the properties amongst us. And you have the decision of Supreme Court in Kale versus Deputy Director of Consolidation, and you have the recent decision of Supreme Court, which is just delivered about two days before. They all have said that the family settlement, which is not to be mistaken for total partition of a Hindu undivided family. I'll reiterate again. Family settlement can be oral. However, just to clarify, in terms of section 6 of the Hindu Succession Act, a partition, there is an explanation below section 6 of the Hindu Succession Act. This explanation has been brought in by 2005 amendment to Hindu Succession Act. A partition would be recognized only if it is registered. So now I'll clarify. If it is partition of HUF, it has to be through the registered partition. There cannot be oral partition. If it is partition of family but not HUF, family settlement, then it could be through oral division. I'll reiterate again at the cost of repetition. Please don't mistake family settlement with the complete partition of a Hindu undivided family. I've already given you an illustration. They are completely different from each other. So you could consider either total partition of a Hindu undivided family or a family settlement, so that the land which you are now putting into JDA is split amongst multiple persons. The whole objective of splitting it amongst multiple persons is to ensure that rather than one assessee, one house, we'll have multiple assessees, and each assessee will have one house in terms of section 54. Even after the amendment by Finance Act of 2014, where they have said that 54 and 54F benefit is available to one house, you could still consider getting adjacent flats and join them together as one big flat and still claim it as one residential house. So you could consider that. Next, you could explore 45.3. So 45.3 is a situation where the landowner will become partner with the developer, whereby he would pump in his land as capital contribution, in which case he could consider a situation where he will pay tax on a much lesser amount at this point in time, because the amount that is recorded in the books of the partnership firm will alone be regarded as a full value consideration. And you could possibly overcome 50C implication, where the stamp duty value will be deemed to be a full value consideration. So next is a case where you could consider a construction agreement in place of JDA, or you could consider the developer and his closely related party as two separate concerns, where you would enter into an agreement with the developer and another agreement with his related party for the purpose of sale of your apartments, where you would make the developer only a contractor, whereby you would sell all your units through the selling agent, who is, because he is closely related to developer interest also would be protected. And you could also consider attaching a lot of conditions in your JDA, and if those conditions are satisfied, only the possession will be regarded to have been given. Otherwise, no possession would move. It's only a license. It all depends on how would you draft JDA. But as I've said earlier, if you attach too many caveats to the JDA, the developer may not be interested in the land itself. He may look for some other more flexible landlord. So you will have to be, making a fine balance of the interests of the landowner as well as safeguarding the interests of the developer. Similarly, whenever you enter into JDA, it is very natural for the developer to insist that you have to execute a GPA. So GPA will be, extremely important here, general power of attorney, through which many a times the landowner gives complete and absolute rights to the developer, whereby developer may even be allowed to sell the developer's share of built-up area, even much before he would even deliver the owner's share of built-up area to the owner. So you could possibly plan your GPA in such a manner where you attach a lot of conditions, where, when, at which point in time the developer can exercise those rights. And then you argue that till those conditions are satisfied, there is no question of GPA being actually effective, and hence 247(6), which I was trying to tell you, another section which you'll have to be mindful of, which will deal with GPA transactions. You will have to possibly limit the risks by attaching a lot of conditions and milestones in the GPA as well as JDA. Now you have the Bombay High Court decision in Chaturbhuj Dwarkadas Kapadia case 268 of 491. Fortunately, this decision is no more relevant because of decision of Supreme Court in Seshasai case, very interesting case which I'm going to discuss now, which will be a big relief to the landowners. And next is a slump sale option, a very interesting thing, which I do not know whether I will have the time to discuss it later on. I could possibly tell you right away, as briefly as possible. Slump sale, where you sell an undertaking. Undertaking itself is a capital asset. Let's say I am having a rice mill. Mr. Ramaswamy is a very famous developer. I'm having a rice mill which with a big, tract of land, big plot of land in which I have a rice mill. And nowadays, my rice mill business is not doing too well, and I may stop this business anytime. Mr. Ramaswamy is interested in this land. So there are two options available to me. One is to raise down this rice mill, make it as a plot, and stop my rice mill business, raise the rice mill, sell the plot to Mr. Ramaswamy through JDA. Of course, he wouldn't have money to give me now. He would insist on a JDA. But the moment I give it out on a JDA, I'm liable to pay tax. As it is, my rice mill business is not doing well. I will not know when Mr. Ramaswamy will develop apartments and give it to me. And when I realize cash, if I have to pay cash now, it will be causing a hardship to me. So other option which you could think of is, I would not give the land to Mr. Ramaswamy. I would sell my rice mill business to Ramaswamy on a lump sum basis. That means I make a slump sale of this to him. But I don't make a slump sale. If I make a slump sale, section 50B is attracted. The moment section 50B is attracted, I'm liable to pay tax. So what I would do is, I will do a slump exchange. What is an exchange? I give my undertaking and don't get cash from him. I'll rather get the apartments from him or the built up area from him. So I'll receive the consideration in kind, then it will become an exchange. Section 118 of the Transfer Property Act explains what an exchange is. So it's an exchange of an existing property between two living persons. Of course, living persons there for the purpose of 118 would include even the incorporated entities also. So if I do a slump exchange, it will not fit into being called as a slump sale in terms of section 242B of the 242C of the Income Tax Act. And section 50B only deals with slump sale. It would not deal with slump exchange. So I may then be able to say that because it is a case of slump exchange, applying the old decision of Supreme Court in Mugniram Bangu's case, 55 ITR 299, and later on the decision of Supreme Court in Punjab Financial Corporation case, 307 ITR 75, PNB case, 307 ITR 75, I may be able to take a position that because it's a slump exchange, I would not know what is the cost of land, what is the cost of my plant and machinery, what is the value of my goodwill in my rice mill business. So consideration cannot be attributed to respective assets therein, and as a result whereof the computation fails, and applying the decision of Supreme Court in B.C. Srinivas Shetty's case, 120 ATR 294, I may take a contention that I'm not liable to pay any capital gains, let alone after 4 years, after 5 years. If I successfully argue on slump exchange, I may not be liable to pay any capital gain tax. So you would possibly consider this. And as you would consider this, of course, you'll also have to keep the client informed of the risks associated with it. The moment you do it, department is bound to resist it. There is going to be litigation. So if your client is prepared for the litigation, you could possibly advise this option of slump exchange. So you have to hear me carefully. It is not a slump sale. Slump sale is chargeable to tax under section 50B. You'll have to look at slump exchange. The other option is you'll have to look at 43(5)(a). Mr. Ramaswamy mentioned this. 43(5)(a) was brought in by the Finance Act of 2017, and 45(5)(a) is applicable only to an individual and HUF. It would provide that where you are owner of land, building, or both, and you are an individual or HUF, you enter into a real estate project agreement. It's called specified agreement with any person, where the consideration would come to you wholly by way of built-up area, or partly by way of built-up area and partly by way of cash, but not wholly by way of cash. That means complete revenue sharing, 45(5)(a) is not applicable. In such situation, what 45(5)(a) says is, you will not pay tax in the year of transfer. You would rather pay tax in the previous year in which the completion certificate is issued by the appropriate authority for whole or part of your real estate project. Then, what will be the full value consideration? The full value consideration would be the stamp duty value of the built-up area that you would get as part of a consideration, plus cash component if you have any, which you have received. So stamp duty value of the built-up area plus cash, if any, received will have to be regarded. So one may immediately jump to conclusion that it's a very beneficial provision, because I don't have to pay tax in year 1, I may pay tax in year 5. For example, in year 1, I entered into JDA. In year 5, the completion certificate is given. So one may jump to conclusion that I will rather go with 45(5)(a) because it is beneficial to me. So you'll have to be very careful here. Merely because you don't pay tax in year 1, but you pay tax in year 5, it did not necessarily be beneficial. If you had paid tax in year 1 when the land is yet to be developed, the stamp duty value of the land will be much less. Whereas in year 5, when the completion certificate is obtained from the appropriate authority, the development would have taken place, the developer's goodwill would have also been incorporated into the project, as a result whereof the market value may have significantly gone up. So therefore, you would be paying tax not on the stamp duty value of your land in year 1. You are paying tax on the stamp duty value of the built-up area that will come to you as of year 5. Therefore, It cannot be always said that 45(5)(a) is beneficial. So you will have to actually do an arithmetical exercise of this and see if 45(5)(a) is really beneficial. If not beneficial, we'll have to look at a method where you don't come under 45(5)(a). You would rather stay with 45(1). So this, of course, you'll have to do after a very close examination of the nitty-gritty of 45(5)(a) provision. Now, so these are the mitigating factors if you have to overcome 247(5). I'll discuss some of these. See, I have only enlisted a few of them, and I'm yet to discuss each one of them in detail. Now, before I proceed further, I'll take a pause in respect of matters which I have discussed. You have any questions? Can you hear me, sir?
So we will take up the question answers after the end of the session, if that's okay.
No, I'm fine. The whole objective is that it wouldn't become too monotonous because they've been hearing us. So if there are any questions right now, we'll take 1 or 2 questions and proceed. Or if there are no questions, then I'm fine continuing it.
In case any of the delegate wants to ask any question, they can post the question in the question box.
Is the question box empty even now?
There is only one question.
Yeah, please tell me.
Just one moment.
It's fine otherwise, no problem. I'm fine even.
Yes, question asked by C. Abhay Srivastav. I'm not able to see the question.
Okay.
I will take up in some more time.
Yeah, no problem.
Questions. Yeah,
that's fine. See, there are two interpretations when no questions come. First interpretation is all the delegates have so wonderfully understood what I've addressed. The second interpretation is, nothing of what I've said has been understood, and therefore there cannot be any questions. So I would assume the first one for the sake of myself. Yes. So we'll proceed now to the mitigating factors. Now, see, the first aspect is, can you have your JDA not registered? Mr. Ramaswamy brought this topic during his keynote address. See, 53A has undergone an important amendment with effect from 24/9/2001. Earlier, there were words like the contract, though required to be registered, has not been registered. These words have now been omitted. The effect of amendment is that 53A would not apply unless the agreement is registered. If agreement is not registered, 53A would not apply. Even an amendment that has taken place in Section 17, 1 year of the Registration Act of 1908, clearly provides that if such documents are not registered on or after such commencement, then they shall have no effect for the purposes of said Section 53A. Now, interestingly, the question is 53A may not apply, but could it still be brought in within the scheme of 247(5)? Because the language used is of the nature that is referred to in 53A. As long as it's the case of an agreement, whether it's registered or not, the possession is given. Some tribunal benches earlier took a view that the amendment would not really matter. 247(5) is still attracted. However, there is one interesting decision of Madras High Court in G. Saroja's case in 301 ITR 124, where the Madras High Court said if the conditions of 53 are not satisfied, then 247(5) would not apply. Ultimately, now it has had the stamp of approval by the Supreme Court in Balbir Singh Maini's case, 398 ITR 531, where the Supreme Court said if the agreement is not registered, number one, 53A of the Transfer of Property Act would not apply. And if 53A of the Transfer of Property Act would not apply, 247(5) also would not apply. In fact, this was the decision of Punjab and Haryana and CS Atwal's case. It went to Supreme Court in a batch of matters where the lead case was Balbir Singh Maini, where the tribunal had held that the transaction of the nature referred to in contract of the nature referred to in 53A, just the nature will have to be seen. It need not be exactly covered by 53A. Supreme Court said this finding of the tribunal is incorrect. It is important that the contract agreement has to be registered so that 53A will apply, and 53A to apply, the agreement has to be registered. If the 53A does not apply, 247(5) will not apply. So in sum and substance, if the JDA is not registered, the answer is 247(5) is not applicable. This has become the law of the land. There cannot be any more doubt on this because the Supreme Court has given its stamp of approval on this. Now, next is another extremely important decision. 421 ITR 46, Sheshasai Steel's case. Though in this case it was adverse to the assessee, for all the landowners, it's a real blessing that has come through this decision. Let me tell you briefly the facts of this case. Sheshasai Steel, way back in 15/5/1998, entered into an agreement to sell in the form of a JDA with one Vijay Shanti Builders for 5.5 crores. In fact, it gave the permission to the developer. You start advertising, you start selling, you construct on the land, all permission was given. Not only JDA, even a GPA was entered into on 27/11/1998, whereby complete power was given to the developer to enter into agreement, even execute sale deed in respect of developer share of flats. And all the title deeds were handed over to the developer. All these things happened. But what happened there? Assessee did not offer it to tax. Very interestingly, in the previous year, 98/99, as per the law then understood, assessee should have offered it to tax under 247(5). He did not offer it to tax. In the meanwhile, some litigation came in. There was a third-party interest which was created prior to 15/5/1998. So there was some litigation, and therefore this JDA did not fructify. A memo of compromise was entered into on 19/7/2003, which fell in previous year 3/4 and assessment year 4/5, whereby because of this memo of compromise, certain amounts were paid to Sheshasai Builders, Sheshasai Steels, and the compromise was made, and the land which hitherto stood in the name of Sheshasai Steel stood extinguished. And what the assessing officer did is, he issues a notice under 147 for 2004/5, saying that it is in previous year 2003/4 the memo of compromise was entered into, and that is when the extinguishment took place. That is when 247(2) got attracted or 247(6) got attracted. You pay tax in assessment year 4/5. Assessee resisted, saying, no, if at all I should have been taxed, I should have been taxed in the previous year 98/99 when JDA was entered into, possession was given, and GPA was executed. So transfer took place then. Transfer did not take place in assessment year 4/5. I am not liable to pay tax. The tribunal and the CIT appeal and the tribunal held, though the JDA was entered into in the previous year 98/99, because of the dispute that arose later on, this JDA was never acted upon in the true letter and spirit, and the very fact that there was a dispute and a compromise deed and the memo was made on 19/7/2003 meant that the 53A was not attracted in 98/99, and therefore it is only in the previous year 2003/4 when the payments were made and the third party interest, that is one Pioneer Homes had, filed a suit here. And he was also paid some compensation, and all these things happened. Last check was paid on 25/1/2004. So 2003-4 is the previous year where you are liable to tax. Now, matter went to High Court. What did High Court do? High Court agreed with the tribunal, but High Court asked one question. Did you pay tax in 98-99? Assessor said no. High Court then got carried away by the fact that no tax was paid in 98-99 and you are liable to somehow pay tax in the previous year 3-4. With due respect to High Court, see, the taxability will have to be determined with reference to a particular year. If it is to be taxed, it has to be taxed in that year. If it misses taxation in that year, merely because you did not pay tax in that year, you can't be made to pay tax in another year. Gajapati Naidu's case, Supreme Court in 53 ITR 114, categorically held that if an income is accruing in 1 year, it has to suffer tax only in that year, and merely because you did not tax it in that year, it cannot be taxed in any other year. So whatever, Madras High Court upheld the view of the ITAT. Matter went to Supreme Court. In the Supreme Court, the assessee argued in 98-99 JDA was executed, possession was given, so 247(5) was attracted. And in 98-99, I gave GPA, power of attorney, so 247(6) was attracted. Because of these two, assessee argued that if at all I had to be paying tax, it has to be only in 98-99. Assessee smartly argued for the reason that if it is 98-99, now there's more than 6 years, it is impossible for department to assess it. So assessee argued, I am not liable to pay tax in assessment at 2004-5. If at all, it is relating to previous year 98-99. This is the argument of the assessee. Now look at what Supreme Court has to say. Very interesting, and you have to hear me very carefully now. Supreme Court looked at the JDA. Clause 16 of the JDA said that what is given is only a permissive license under Section 52 of the Indian Easement Act. And Supreme Court said that because it is a permissive license, it cannot be regarded as a possession. And then Supreme Court went on to say that the possession is a legal concept. It denotes control over land and not just the actual physical occupation of the land. So what is important is the legal possession, not the physical occupation. The moment the agreement very clearly says what is given is not a possession under 53A, but is a permissive license under 52 of the Indian Easement Act, Supreme Court said 53A is not attracted, and therefore 247(5) is not attracted. Now, what the Supreme Court said is the moment it is so mentioned that it is a license, they said the license per se cannot be said to be a possession at all. Possession is a legal concept. It denotes control over land, and mere physical occupation of land is not the possession. And therefore, they have said 53 is not attracted, 247(5) is not attracted. And the Supreme Court went on to say that merely because the power of attorney is executed, it would not alter the situation in any manner whatsoever. Now, this is a very, very important decision. As the consultant of the landowner, you may always say that in the JDA that what is given is only a permissive license and not a possession. So rest of the things will continue. You just have to have this specific clause in your JDA. Then you would comfortably overcome 247(5). Now, if 247(5) is overcome, there is no transfer. And because there is no transfer, at the time when you enter into JDA, 45(5)A also will not apply. I mentioned to you 45(5)A, which applies only in the limited context of individual and HUF, where it will be charged to tax in the year in which the completion certificate is obtained. But that would arise only if in the first place there is a transfer. So there is no transfer at all here. And therefore, it's very easy now, after the decision of Supreme Court in Shah case, to overcome 247(5) by suitably having this clause in the agreement. Now, in an interesting situation here, continuing with the Chythanya case, because this has dealt with two aspects. Assessee argued, if not 247.5, at least 247.6 is attracted. What is 247.6? If you go to section 247.6, it says any transaction, whether by way of becoming a member or acquiring shares in a cooperative society or a company or an association of persons, or in any agreement or arrangement or in any manner whatsoever which has the effect of transferring or enabling the enjoyment of immovable property. So Board Circular number 495 of 1987 says that where you enter into power of attorney, 247.6 is attracted. So assessee argued, so I entered into power of attorney in 98-99, so 247.6 is attracted. Therefore, transfer took place in 98-99. Nothing happened in 2004-2005, so don't tax me. Then the Supreme Court said, no. Though you have given a power of attorney, what is important is enabling the enjoyment, which is there in 247.6, will take color from the expression transferring, which it succeeds. And unless your power of attorney would mean a de facto transfer of immovable property, 247.6 is not attracted. So merely entering into general power of attorney would not mean a de facto transfer has taken place, and 247.6 cannot be then pressed into service. So it's a very interesting case where when you enter into GPA, you will have to make sure that you are still the de facto owner of the property. See, many a times the GPA that you would execute, the developer would insist that you give the right to the developer to be in a position to enter into agreement and even execute the conveyance in respect of developer's share of flats. Then in which case what you have to do is, even if you have to give such power, you give such power to be exercised after the developer delivers your share of built-up area. Let us say in our agreement, 100 flats Mr. Ramaswamy would build and he has to give me 30 flats. He would insist that I have to give him a GPA so that he will keep selling the 70 flats and raising money. Then what you have to do? You can enter into agreement, no problem. But you cannot execute conveyance deed for 70 flats in favor of 70 customers till you deliver 30 flats to me. Then what you do is, till Mr. Ramaswamy delivers 30 flats to me, I continue to be the de facto owner. Therefore, 247.6 is not attracted. So on this basis, the Supreme Court said neither 247.5 is attracted nor 247.6 is attracted in 98-99, whereas the compromise deed, the memo of compromise, which was entered into in the previous year 2003-4, in fact resulted in extinguishment of your rights, and hence 247.2 is attracted, and therefore you are liable to pay tax in the assessment year 2004-5. As I said earlier, the decision was adverse to assessee in Chythanya case, but it is a boon to the other landowners. Now, as you would see this, there is one important decision of Supreme Court you'll have to watch out. There's a decision called Unitech Limited, which was reported in 2015 Tax Sutra 639. The decision was rendered in the context of 269 UA, chapter 20C, which now does not exist. It dealt with purchase of immovable property in the case of undervaluation of consideration. So in that context, in a similar situation of joint development, Supreme Court held that it is to be regarded as a transfer under 269 UAF. That also is a Supreme Court decision. Chythanya Steel also is a Supreme Court decision. But the interesting part is, Chythanya Steel is a decision by a bench of 3 judges, whereas Unitech Limited is a decision by a bench of 2 judges. 1. 2. Chythanya Steel is in the specific context of 247.6, whereas Unitech is in the specific context of 269 UA. There the purposes are different. The objectives are different. Therefore, a decision rendered in the context of Unitech Limited cannot ipso facto be applied in the context of 247.6. So that's about the aspect of 247.5 and 247.6 and how the decision of Balbir Singh Maini's case in 398 ITR 531 and the decision of Seshasai Steel's case in 421 ITR 46, where the landowners are now greatly, benefited, and these two decisions would come in extremely handy for the benefit of landowners. And before I go to the next point, maybe I'll take a brief pause and ask you if you have any questions so far.
If anybody is having questions, they can put the questions in the question box.
It is not a mandate for them to raise questions. If they have questions, they may raise. No questions?
No, sir.
Shall we proceed?
Yes, sir.
So now there is one more aspect of you not having to really pay tax at the time when it enter into JDA. So typically what will happen when I enter into JDA? Do I get any right to demand the flats be delivered immediately? No. So the language of section 45(1) is extremely critical. It says capital gains arising. What is the meaning of arise? Arise means there is an income which is ready for you to take. You have the decision of Supreme Court in E.D. Sassoon's case, where they have discussed elaborately what is the meaning of arising. So arising means income has to be ready. In your case, you're just given land on JDA. Later on, the developer will have to take the approvals, do the plans, get the approvals of the plan thereafter, and then go ahead and invest money, build the apartments, get the completion certificate and the occupancy certificate, then then you'll have to have an area sharing agreement as to which flats, which floor you will have to get. Then only you will have a right to go and demand the flats. Till then, you don't have a right. So because you don't have a right to receive, there is no question of capital gain arising. So this is the important part of section 45(1). And in this context, again, Balbir Singh Maini's case, which I discussed a little ago, would also deal with this aspect of accrual and arisal. See, in Balbir Singh Maini's case, it so happened that some landowners who were members of a society had to have their flats redeveloped. These flats have become too old. They are part of a society. So they identified a developer who will, raise this to ground and rebuild, and he will keep some floors and he will give you all one flat each. Now, an agreement was entered into. This was, structured in a manner where initially an advance of 3 crores will be paid, and later on another 15 crores will be paid, and 3 acres of land will have to be transferred. Subsequently, 23 crores will have to be paid, and 4 acres will have to be transferred. Subsequently, 31 crores will have to be paid, and 6 acres will have to be transferred. And subsequently, another 32 crores will have to be paid, and 7 acres will have to be transferred. So overall, consideration was 106 crores for 21 acres. Now, what happened in this case was that first 3 things took place. Advance was paid, 3 acres were transferred, 4 acres were transferred, 15 crores and 23 crores were paid. Assessors offered this to tax. But subsequently, it so happened that there was some interdiction by the High Court. It went into litigation. The development could not take place. But the assessing officer insisted the landowners to pay tax on 106 crores, full amount. I said, I don't know all that. You had given a GPA, you had entered into JDA, 247.5 is attracted, 247.6 is attracted. Then, when the matter went to the High Court, CS Atwal's case, Punjab and Haryana High Court held that it held various aspects. In fact, it held that there was no effective possession given at all because it's only a permissive license. It also held that 247.6 is not attracted. And it held that, both 247.5 and 247.6 were not attracted. No liability to pay tax at all would arise. The matter went to Supreme Court. Supreme Court interestingly held the following things. One is, it said, as I've already discussed, because the JDA is not registered, section 53A is not attracted. And because 53A is not attracted, 247(5) is not attracted. And therefore, you're not liable to pay the tax. When it comes to 247(6), on the basis of GPA, what the Supreme Court said is, look, is there a right to receive? What is the meaning of right to receive? It went into the meaning of right to receive, went into the decision of Supreme Court in E.D. Sassoon's case, then considered Morbi Industries case in 83 ITR 832, looked at Excel Industries case in 358 ITR 295, and in sum and substance it said, what is the meaning of arising is, the landowner should have a right to receive flats, which means the developer has an obligation to deliver flats. So now the question is, the moment you enter into JDA, does the developer have an obligation to deliver the flats to you? No. When will he have the obligation? He will have to build, get the occupancy certificate, then only he will have the obligation to give you the flats. Till that obligation to give you flats arises for the developer, you don't have a right to receive. If you don't have a right to receive, there is no question of arising. And therefore, you're not liable to pay the tax. This is another important aspect of Balbir Singh Maini's decision, which you will have to use to argue that the landowner is not liable to pay tax because there is no arising of capital gains. So next, we have addressed how you have to overcome 247(5) and you have to overcome 247(6). Another option where you can defer the payment of taxation is to convert your land into stock in trade. What will happen when you convert the land into stock in trade? Under section 45(2), read with section 247(3), your conversion of capital asset or its treatment by you as stock in trade is deemed to be a transfer. And under 45(2), you are liable to pay tax on profits and gains arising from such conversion, but not in the year of conversion. You are liable to pay tax in the year in which the converted stock in trade is sold or otherwise transferred. I'll give an example. Let us say I bought an asset 10 years before. Today, now it's year 1, let us say. In year 1, I bought the land. In year 5, I convert it into stock in trade. Last 5 years, I've held it as capital asset. In year 5, I'll convert it into stock in trade. And as soon as I convert it into stock in trade, I'll give this land in JDA to a developer. Now, developer will take this land in year 5, develop, and in year 8, he will give me 30 flats. And in year 10, I sell these 30 flats. The question is when I'm liable to pay the tax. I'll repeat. Year 1, I bought the land. Year 5, I convert that into stock in trade and give it out in JDA. Year 8, he will give me 30 flats. Year 10, I sell it. If I do so, can I defer the payment of tax? Now, if I don't convert, give it out in year 5, possibly I may have ended up paying tax, subject to Seshasai and Balbir Singh Maini principles which are discussed. So I do not want to pay tax in year 5. So what I do, I convert it. The moment I convert it in year 5, what they do is, they will compute the capital gain in year 5 by adopting the fair market value of this land in year 5 by applying the stamp duty valuation. They compute the capital gain by taking the cost from year 1, indexing it from year 1. Let us say capital gain will come to 2 crores. But it only computed. I don't pay it in year 5. I don't pay it in year 5. It only computed. When I'll pay, when this converted land is sold or otherwise transferred. Now, the moment the land is converted into stock in trade, and then given an JDA to the developer, what I'm giving is not capital asset. What I'm giving is stock in trade. So 247 is not attractive. 247 is not attractive. Then, but could it be said that it is otherwise transferred? Then the decision of, like Madras Tribunal in R. Gopinath's case and the Karnataka High Court in Wipro case, they have said that while understanding the phrase otherwise transferred, it has to be meaning something similar to sold. You cannot import the meaning of transfer under 247 into the other word otherwise transferred. So when I give it out in JDA, it is neither sold nor otherwise transferred, so I'm not liable to pay tax on these 2 crores in year 5. Now, next question is, when will I pay tax? Do I pay tax in year 8 or do I pay tax in year 10? In year 8, what will happen? I'll get 30 flats. But do I get any sale consideration? I don't get sale consideration. I don't get monetary value, which I'll get only in year 10 when I sell away these 30 flats. In year 8, I'll only get, there is an exchange that will happen in year 8. I get 30 flats and my land will go. Am I liable to pay in year 8? If you look at 2 decisions, one in Nagpur Sugar's case in the context of sales tax and one in income tax in the case of Orient Trading Company's case, they have said that if one stock in trade is exchanged for another stock in trade, you may still be liable to pay the tax. In Orient Trading, it so happened that I had Hindustan Liver shares, I exchanged it for Britannia shares. And I argued that I'm not liable to pay tax because exchange is not to be charged to tax under section 28. It is a transfer only for the purpose of capital gain. Supreme Court disagreed with this. So on this basis, could it be said that on 30 flats, I am liable to pay tax in year 8? My view is, it's possible to distinguish Orient Trading case. It is not a simple exchange of one stock in trade for another stock in trade. When I give land in JDA, 100% land is given, and I get 30 flats, which means I'm not transferring 100% land. I'm only transferring 70% of land, and I get 30 flats. I still retain my 30% of land on which these 30 flats notionally stand. I will still keep absolute interest in respect of so much of land on which my superstructure stands. That means I have transferred to the developer only 70% of land. The balance 30% of land is still my stock in trade because I already converted. Then once the developer builds the apartments, it will be like improvisation of that stock in trade. It will become one composite stock in trade of land and building. Unlike in the case of Orient Trading, there is a complete change in the nature of holding. I had Hindustan Liver shares, now I have Britannia shares. Here it is not like that. I've held land as inventory, and these 30 flats come over that inventory, continue to be inventory in an improvised format. Like you buy raw material, you make semi-finished goods, are you liable to pay tax? You make finished goods, are you liable to pay tax? Because raw material is no more the raw material. Answer is no. You are liable to pay tax only when you sell it. So on this scheme of things, in my view, you are liable to pay tax only when you sell these flats in year 10. In year 10, you pay tax not only on the business profits you make, you also pay tax on these 2 crores which was quantified and kept in limbo in year 5. So together you pay tax in year 10. Now, there are a lot of other issues here as to whether indexation is available up to what date. Because I bought the land in year 1, I converted in year 5, and I sold in year 10. I am liable to pay tax in year 10. Should the indexation stop at year 5 or should it run up to year 10? No. Very strictly speaking, indexation should stop in year 5 because that is when you quantify the capital gain. But interestingly, there is one decision of Karnataka High Court in Rudra Industrial Commercial Corporation, 20taxman.com 611, where it said that the indexation could run up to year 10. So it's a very, interesting decision, but I'm sure, this decision may not be right. So if you're lucky enough, this decision would stay. Otherwise, Supreme Court may, when challenged, upset this particular decision. And in year 10, when you pay tax, you have to be careful. You are paying tax on 2 things. One is you pay tax on 2 crores capital gain, which was computed in year 5. And then you pay tax on the business profits in respect of sale of these 30 flats. But what is the cost to you? The cost to you is the fair market value of your converted capital asset in year 5. That is the cost to the business. Supposing I bought the land at only, like 50 lakh in year 1, it has now become 2 crores. And when you converted it into stock in trade, you can't just adopt 50,000. On the date of conversion, what is the fair market value? That will have to be treated as your cost to business. This principle was brought out by Supreme Court in an old decision called Bai Shirin Bai Kuka. In 46 ITR 86, Supreme Court said when an individual capital asset is pushed into business, cost to business is the fair market value on the day when the asset is converted as stock in trade. So with this, I think my time is up. And if it's 7 already, so there are so many things to discuss and it will go on forever. So we'll have to put an end to it. And
So
if you
just wrap up the important issues in say around 10-15 minutes, if you say so.
See,
whatever are the important points which you can cover on that.
See, it's very difficult to wrap up, but I would give you some more clues which you could possibly think of. I'll not now take you through the slides because it will take time. So there are a few more things which you could possibly think of, some tips. One is I've already explained you the slump exchange. Another thing is, making use of section 50D in a revenue sharing arrangement. What is the scheme? Just consider this. Let us say I have a plot of land. I enter into JDA with Mr. Ramaswamy for revenue share. What is revenue sharing? He will not give me 30 flats. Whenever he would sell 100 flats, he will give me 30% thereof. But he will not give me any area. This is called revenue sharing. Now, I do not want Seshasai Steel, I do not want Balbir Singh Maini, I want to pay tax upfront. So I enter into JDA with him. And one more thing you need to understand is, under when it's complete revenue sharing, 45(5)(a) is not applicable. So I will want to pay tax now in year 1. Let us say, on what amount do I pay tax in year 1? I have to pay tax on the full value consideration. What is the full value consideration? How will I know that? Because he is going to build apartment, God knows when, then he will sell, which year he is able to sell, how much revenue he will share with me, I will not know. So therefore, I would have argued that consideration is indeterminate and unascertainable and I would not pay tax. In fact, Hyderabad Tribunal in Radhika Builders case agreed with this. So what they did is they brought in section 50D by Finance Act of 2012, wherein they have now said if the consideration is indeterminate or unascertainable, you apply the fair market value of the outgoing property, the land which I am giving to Mr. Ramaswamy for development, take its fair market value. What is the fair market value? Stamp duty value. So what I will want to do is, I will want to upfront pay tax by taking stamp duty value of the land. Let us say it comes to 2 crores. I pay 20% tax. Then what would Mr. Ramaswamy do? He would develop, after he has a very wonderful brand image. Using the brand, he is able to sell the apartments at premium prices. Then let us say over a period of say 5-6 years, he will sell 100 flats for 100 crores. And he will give me 30 crores. Whereas I've already paid tax only on 2 crores. The question is, am I liable to pay tax on balance 28 crores? It is a capital receipt, but it is not arising from the capital gain because it is already closed, frozen. In terms of section 50D, the story is over. It is not a revenue receipt. It is a capital transaction. So it is not liable to be taxed at all. See, capital receipt cannot be taxed by default. It can be taxed only by exception, by a fiction. So 45(1) is one of such exceptions. Now 45(1) has already told me this is the tax on 2 crores which you have to pay under 50D and I've paid the tax. So subsequent revenue receipts from me, revenue sharing receipts, which will be 30 crores in this example, Whereas I already paid tax on 2 crores. I may not have to pay tax on 28 crores at all. The only risk is department may say, because you are into revenue sharing, you are deemed to have converted the land into stock in trade, and we'll call the 30 crores as business income. It's not very easy for them to regard this as conversion, because conversion of land into stock in trade would require a positive conduct from my end. It cannot be by assumptions and presumptions. I am not doing any business. I only told Mr. Ramaswamy, take my land and develop and give me 30%. For it to be regarded as business, I have to participate in the development. I have to participate in the sale. I am not doing all that. I am only a mute contributor of land. I don't know what Mr. Ramaswamy does. The only condition is everything he has to handle. He has to give me 30%. Therefore, it cannot be said that I have converted this land into my inventory. So this is another tax planning option which you could consider. So there are a lot of issues. Each one cannot be summarized so quickly. Each issue will have to be discussed in detail and understood, and then we could possibly summarize. So let us not hurry through. We will, I do not want to rush through all the slides and say that I have completed the discussion. Agenda is not to complete the discussion. Agenda is to have a meaningful interaction of whatever a few topics which the time will permit us to discuss. That's why now I will, yeah. Yes.
You just look on the example which you said, that when a person transfers it at that moment itself, at the time of agreement itself, the example which you gave just now, when a person transfers the property at 2 crores and then thereafter enter into a revenue sharing agreement.
They're not thereafter. In the JDA itself, it's a revenue sharing JDA. Whereas I would pay tax in year 1. On what basis? On the basis of section 50D. What 50D says? Full value consideration shall be deemed to be the fair market value of the outgoing asset at the time of transfer. Matter ends. Full value consideration, it's not part value consideration. So the law will create a fiction to say that in this entire scheme of things, full value consideration only so much. That is the stamp duty value.
Can this be taken as a good tax planning?
What is it?
Can this be considered to be a good tax planning if we say that the property is going to appreciate very much in future?
No, we see what is tax planning? When the law is clear and you don't, do any colorable device. You're not doing any colorable device. What is colorable device? You call something else, where form and substance are different. Here they're all the same. Is there any denial of fact that I am the landowner? No. Is there any denial of fact that Mr. Ramaswamy is a developer? No. Is it not agreed between us that he would do the development and share 30% with me? Yes. There's no denial at all. This is the law. Law, whether you would want it or not, the law says you take it as this, 2 crores. That's it. So there is no harm in it.
Sounds good.
It is for the parliamentarians to see the mischief and make the amendments to law. As far as you are concerned, there is no cheating you are done. This is the provision of law which you have applied. There is no colorable device. McDowell's will not apply. Rather, Azadi Bachao will apply to you. Azadi Bachao Andolan will apply to you. 263 ITR 766. And Vodafone 341 ITR 1 would apply to you. McDowell will not apply to you.
That's very interesting. So I feel let's keep it something on the question answer part. If somebody is having any questions related to the particular scenarios, I feel even if anybody is having any particular scenario to discuss, even that can be put up, because that would be really beneficial for all others to get an understanding into it. So till the questions come, I just try to encroach into some other area. If I link this with RERA, I'm just trying to put it that if there is a plot of land which is comprising of three owners, and now these three owners enter into a JDA with a builder for developing the property. Now these are three different owners. For the purpose of RERA, the property is registered in one, they've got a single RERA number for the entire property. Now, does this make any difference as far as the JDA is concerned?
Absolutely no. As far as income tax is concerned, it would not make any damn difference.
Because RERA is going to be only one number for the entire structure.
RERA has a different purpose to achieve. It has got nothing to do with the taxation part. RERA is brought in to safeguard the interests of the people who would book for the apartments, who book the apartments. The developer has committed to fulfill certain promises. There is a time-bound manner in which he has to fulfill those promises. Otherwise, the people who have booked the apartments will have a right to cancel the apartment. They're entitled for compensation if there's a delay. So these are all, a scheme of a different statute which has a different purpose to serve altogether. Merely because one JDA is entered into, one RERA number is allotted, it would not make any difference. See, income tax would go by the concept of co-ownership. Section 42 to 47 of the Transfer of Property Act. Section 45 very clearly provides that, when there is one property where multiple owners are there, in the absence of any contract to the contrary, their respective interests in the property will be proportionate to the cost which they have incurred respectively. So it's a case of co-ownership.
Just I've got a question on the same that Mr. Table asked for that. In the same scenario, if the plotting is done instead of construction, if only the plotting is done on that property, what would be the scenario then?
See,
3 or 4 owners.
Is it that there is no construction, but it's just the making of layout, and some sites will be given?
Yes.
So it would not make much of a difference, except that, see, let's say I and you and Mr. Ramaswamy, 3 of us own about 2 acres of land each, okay? So we have 6 acres of land. We will give it to Mr. Jaydeep to develop. What he will do, he will not build apartments. He will rather take this land, he will even it out, make roads, build culverts, have the facilities, poles, electricity, water, sewage, all that facilities he will do and convert them into sites. And will give us sites. Correct? Is that your question?
Yes, yes.
So here also, it's not going to be greatly different from the point of view of construction of an apartment. It may so happen that we will have lost the identity of these 2 acres. We would have been required to give entire 2 acres each, together 6 acres to Mr. Jaydeep, and we will not be taking back the sites in our respective lands of 2 acres. Say, for example, I get 10 sites. These 10 sites need not necessarily be situated in my 2 acres plot. So it's all fungible, in which case it's not different from me getting apartments. It's just the same. The treatment is not going to be different.
So the taxability would still be it would still be taxed in the year of transfer.
No, it depends again. No, it depends. See, whether you ultimately get back the apartments or get back the sites per se will not make a difference. Taxability will have to be determined on the basis of the interpretation which we have carried out so far, whether 247.5 is attracted, 247.6 is attracted, whether Seshasai will come in, Balbir Singh Maini's decision will come in. Those principles will have to be applied. When you apply those principles and read these sections, it doesn't really make a difference whether you get back apartments or you get back sites, is what I'm trying to clarify.
Okay.
Concept remains the same. Quantum may vary. Quantum may vary because if you only get the sites, you can't take the benefit of 54. You can't take the benefit of 54F. If you have to get the apartments, at least for one apartment you can get. Like this quantification could possibly vary, but the concept will remain the same.
And so the issue basically remains is that we have got one single RERA registration, and in that RERA certificate you put in that this much is the construction or this much is the work that has been completed. And then if you look at the 3 owners, what we have discussed, these three owners may be having different the shares, the different parts which have been completed or not completed. So whether that will make any complication, but as we have said, the issue is clear. We have to see as per the condition, as per the JDA, what are the terms considered in that.
Absolutely.
Right. In case there are any more questions, I'm not finding any questions online.
Then we may conclude.
Sure, sir. Sure, sir. Fine, sir. Fine, sir. It has been really nice of Chythanya sir to take out his precious time and come out on this important part. So we will definitely would like to have this presentation. If you can share this presentation, so we will put up this presentation on our website, which can be of use for the members to refer to the case losses. Right, sir. Thank you so much, sir. On behalf of Nagpur branch of WIRC ICAI, we are extremely thankful to Chythanya sir for sparing his valuable time, making this session very interactive, very interesting to say, though it has been put on a pause. But yes, I feel in case the issues remain, we will definitely come up on more questions on that. I'm sorry, sir, I'm having some questions. Can we take up, sir?
Yeah.
What if rural agricultural land is converted into stock in trade?
See, first of all, rural agricultural land is not a capital asset. So therefore, I would not recommend you to convert that into stock in trade. However, there are some issues that would arise when you are a land gatherer. Who is a land gatherer? Land gatherer is a person who is by law enabled to buy agricultural lands, convert them, and then give it out to a developer. For example, in many states, or at least in a few states, there is a restriction on purchase of agricultural land by a non-agriculturist. So in Karnataka, till recently, we had that restriction under Land Reforms Act. So what people would do is to identify a person who is presently an agriculturist. What his job is to go and buy out the lands from the farmers. So that's agricultural land. Then he would convert them and give it to me. See, there are some situations where when he keeps buying these agricultural lands, the department has taken a view that, see, your business is to gather the land. You are a land gatherer. Because you're a land gatherer, the moment you buy the agricultural land, it is a stock in trade. The moment it is stock in trade, it's not a capital asset. So therefore, you are like a dealer in agricultural lands. A dealer in agricultural lands, the profits he makes cannot be called as agricultural income. Agricultural income is defined in 2(1)(a). When you buy and sell agricultural land, like how you buy and sell paddy or jowar or whatever, it wouldn't be treated as agricultural income. So that's the risk which a land gatherer will have when he keeps aggregating lands for the purpose of sale to the developer. So therefore, if even if you convert your rural agriculture land into stock in trade, you may not be liable to pay tax on conversion, but unnecessarily later on, that stock in trade will have become your business stock. When you sell it, you are liable to pay tax.
Right, sir. Right, sir. So there's one owner. If a landowner enters into agreement now and gets amount after completing the project from the builder, then which year tax rate is applicable? That is,
I've already given examples. It depends. See, in your example, it's a case of yeah. In your case, I think it's a revenue transfer, revenue sharing. He will get the amount. He will not get the area. Correct?
Right.
So 45(5)(a) is not applicable because it doesn't get the area. He gets only cash. Then you have to examine 247(5) and 247(6) in the light of Seshasai principle and Balbir Singh Maini principle. Is possession given? Is JDA registered? Is it a possession or a permissive license? If it is a possession given in terms of 53A, 247.5 will get attracted. Then on what amount you pay the tax? On the basis of fair market value of the outgoing asset, you have to apply 50D. I've already given you an illustration of all that. The same thing would apply. You have to pay tax in year 1, provided it satisfies and it fits into 247.5 and 247.6. If you manage in a manner where it will not be regarded as a transfer under 247.5 or 247.6 in year 1, then you don't have to pay tax. How will you manage? I've already given you clues. Don't have JDA registered, or don't give possession, call it as permissive license. In the GPA, you attach a lot of conditions. Then in which case, you don't have to pay tax in year 1. You have to pay tax only when you get the consideration.
Right. Mr. Anand Subramanya, fine. Request to share the balance topic slides of Mr. Chaitanya. Okay, fine.
Yeah, it would be done. Slides will be shared.
Mr. Adish Agarwal, please put light on landlord is under JDA of both land sharing and revenue sharing of same property.
Can you come back?
Please put light on landlord if it is under JDA of both land sharing as well as revenue sharing of the same property.
Okay. So it's a mixed situation where I have some land, I'll give it to Mr. Ramaswamy, who is a developer, who will give me 30 flats as well as he'll give me 5 crores. Or he may give me 30 flats and on balance 70 flats, he will share 5% with me. Yeah. So there's a mixed situation. So when there's a mixed situation, same thing will apply. Whatever I've explained earlier will apply, except that it has to apply in parts. So whatever I've explained in area sharing will apply to the extent of area I get. Whatever I explained in revenue sharing will apply to the extent of revenue share I get. And beyond that, like it depends on terms of the contract, kind of JDA clauses therein. But the concept as such would not vary. One small variation is if it is a mixed situation of both area and revenue, you could go for 45.5A. 45.5A, where you'd want to defer the tax to the year of completion. You could do it if it is complete area share or a mix of area share and revenue share. But if it is only revenue share, 45.5A will not apply.
But in this big I feel 45.5A will apply, and in the year of transfer only they can take the benefit. In a mixed contract.
45.5A is applicable. You don't pay tax in the year of transfer. You pay tax in the year of receipt of completion certificate.
Completion certificate. Full.
Yes.
Full.
Yes.
Right, sir. So this is the questions for today. I feel the questions will come on now, more on that, because after the thing is started, people get to ask more questions. But at this moment, we have to put an end to this show off today. I will say on that. On behalf of Nagpur branch, we're extremely thankful to Chaitanya sir for sparing his valuable time and his vast field of knowledge. We're extremely thankful to Honorable Past President CA G. Ramaswamy sir and CA Jaydeep Shah sir for guiding the members on the all important issues of taxation. The issues are going to be many, but the real estate is going to be there for forever. For we practicing chartered accountants, the opportunities are always going to be there, but the complexities are also going to be there. Let us try to solve all these complexities in the best possible manner. I wish all of you a very happy Independence Day for tomorrow, and I wish everybody a very happy learning. And thank you so much on behalf of Nagpur branch. Thank you all. Thank you, Chaitanya sir.
Thank you.